sophisticated investor certificates typically has a shelf life of 2 years. However, if you are looking to obtain early stage innovation company investment tax offsets, that certificate needs to be, it's unreasonable to expect a win on one investment. And I guess a better approach is to build a portfolio of investments. So you need to make sure that you have the ability to build a portfolio. You're not just writing one check, you're actually writing a number of checks to build a solid portfolio of companies.
Welcome to another episode of Founders and Finance, where every episode we dig deep into the insights that shape Australians' financial well-being. We have real conversations with business owners, investment experts, professionals, and everything in between to bring you the real-world stories and insights into today's financial world. Whether you're a small business owner, an aspiring investor, or simply looking to strengthen your financial foundations, there's something here for you. I'm your host, Ross Pocock, co-founder of Sternlight Financial. And today I'm joined by Roman, managing partner of Recit Advisory and boutique accounting practice that focuses on founders within the tech startup space, where they help founders take control of their numbers so they can scale with confidence. Right, let's jump in. How's your morning been, Roman?
So far, so good. Thank you, Ross. How are you?
Yeah, it's been a good morning, nice and cold in Brisbane at the moment. So, obviously, thank you for coming on today. Obviously, we've had a bit of a conversation in recent times, and I really wanted to highlight the white paper research that you sent out regarding sophisticated investors. So, what made you do the white paper research there?
Yeah, nice, Ross. What we're doing with our firm is, I think it's worth noting that our firm is only just starting, right? So we're in a year one of operations, and we're really focusing on advice to, I guess, this cohort of people that we're identifying as wealth creators, right? So it's people that are founding businesses, acquiring businesses, investing in businesses. All of them are stakeholders in this startup ecosystem in Queensland, but in broader in Australia. In early conversations that we've had with some young professionals in particular, is that many are just plain not aware that they may be meeting the requirements of being sophisticated investors. And so, as such, they're not aware of the opportunities that exist for sophisticated investors and what benefits those opportunities can bring as well. So as part of our advisory work, we're not only looking to help founders, but also young professionals and sophisticated investors that are looking to participate and work with those founders.
Perfect. And obviously, you talked about the sophisticated investors and people not knowing what they fit that category. So, what makes a sophisticated investor?
At a high level, there are, I guess, two main requirements. You need to satisfy either or, and that is you either need to have income of over $250,000 in the last 2 income years or have net assets over $2.5 million. And those rules have not changed for a very, very long time in Australia, right? And as you know, there was a lot of conversation about updating and changing those rules in the last couple of years, and those rules ultimately remained unchanged. But what we're seeing is, with that level of income being unchanged for so many years, $250,000 per annum 10 years ago was a lot more money than it is now, right? So what that's doing is effectively increasing the cohort of people that are qualifying to be sophisticated investors.
Definitely. It's something we're seeing more and more. I went to a talk recently about this, and I think they highlighted that when the rules first came into play, there was only about 2% that would actually fit in that category, and now it's kind of over 30% of Australians can fit in that category. And I think one of the big factors here is obviously people's homes are included within those net assets as well, aren't they?
People's homes and their superannuation balances as well. So you're right. That again sort of pushes that the size of that cohort larger. And you mentioned it as well that I guess some of the individuals in that cohort are not very sophisticated investors, right? They just meet the criteria. It doesn't necessarily mean that they are sophisticated and that investing in things that don't come with the PDS is a good idea for them.
Yeah, no, definitely. You got to find people still have to have that level of education to be within that area. Otherwise, they will end up getting stung. So, in terms of sophisticated investor, why would someone want to be signed off by an accountant to be a sophisticated investor, as opposed to just being a normal retail where they have that extra level of comfort amongst the advice?
Good question, Russ. Right, and it's I think there's a group of people that do sort of have come across opportunities either in venture capital or in wholesale funds, and they are not given access to those opportunities without being certified as a sophisticated investor first. So they approach their accountants to obtain the certification. And then there's the other, I guess, cohort of people who are looking to make an investment in an early stage innovation company and want to ensure access to the ESIC tax offset, which also requires a sophisticated investor certification. What's interesting, I think, is again in Australia, the requirement to go and see your accountant to get certified is interesting, right? There are other professionals that are able to quantify your level of income and assets. I think it can probably be open broader to other advisors that are working with investors.
Yeah, look, I agree, but I think it's like anything when it comes to government making changes to certain things that only affect a small number of people, obviously a growing number, but it's still in that area. They can be a little bit slower in making those changes because it's not necessarily relevant straight away, although it does make it easier. It's not necessarily relevant compared to a lot of the other issues that they have on their plate within that. So you mentioned about the tax incentives from the early stage innovation companies. So how does that work? I found it quite interesting reading your white paper in that space. So if you can expand on that and what that means from a venture capitalism point of view.
Absolutely. So I guess it's natural that a lot of innovative companies are either creating a category or sort of pursuing something that's truly new to market, and that often requires a fair bit of capital. And those companies often go through a series of capital raises. But in the early days, the early stage innovation company rules sort of come into play and can offer fairly attractive tax incentives for investors that are putting money in those companies at really early stages, right? Where risk profile is probably the highest. A company can qualify as an early stage innovation company if it's young, right? So sort of less than 3 years old or even less than 6 years old if another criteria is met. And if it also satisfies either the 100 points test or the principle-based innovation test that describes it as an innovation company. The 100 points test is, I guess, a lot clearer, right? And it's you tick the boxes and you make sure that you score 100 points. The principle-based test is a little bit more, I guess, subjective, so it requires a little bit of judgment. But the 100-point test is pretty clear. So those companies that are going out to raise capital, they can raise capital from sophisticated investors or not. It doesn't really matter to the company, but to the investor, it does matter. If you are not a sophisticated investor and writing a check over $50,000, then no tax offset is available to you, which is really quite limiting, right? So you want to make sure that if you can be a sophisticated investor, you satisfy the sophisticated investor rules before you write the check into the company. And for the purposes of the tax offsets, there are actually, I think, 5 ways that you can meet the sophisticated investor requirements. One being the certification by your accountant based on your income and net assets. The other is if you write over $500,000 into the same class of shares and in the same company. So that can deem you as a sophisticated investor. If you're being offered the opportunity through an Australian financial services licensee, that can tick the box. Also, if you're a professional investor licensed yourself, or if you have assets over $10 million. So if you tick some of those boxes, you may be deemed as a sophisticated investor. But I guess the easiest way, again, is to approach your accountant and ask for certification. The one thing that's interesting is the sophisticated investor certificates typically has a shelf life of 2 years. However, if you are looking to obtain early stage innovation company investment tax offsets, that certificate needs to be no more than 6 months old before you're being offered the deal, right? So it really helps to, I guess, do a little bit of planning, talk to your advisors and accountants before you make the investment. If you make the investments and then approach your accountant at year ends, it might be out of luck. So in ideal circumstances, you want to plan for these things before you write the check.
Yeah, no, definitely. And like you say, you got that 6 month window there, and you might have that sophisticated investor certificate. But if it's longer than that period of time, that might really affect you further down the line, rather than you might not think about it right now, but 5, 6 years down the track, if you go to sell out of one of those companies that you've invested in, that could have a significant impact on you.
Absolutely, and I think that's kind of one of the benefit is the tax offset, the carry forward tax offset is really great, right? It's 20% of your check, and it can be carried forward into future income years if it completely offsets your income tax in this year. But also the highly attractive capital gains tax rules are also applicable to these investments, where if you hold the asset for more than a year but less than 10 years and there's an exit and a liquidity, then you're exempt from capital gains tax on the gain that you make on that investment. So I think that can be absolutely huge, right? And it's you want to make sure that all your records kept well and that your documentation is prepared beforehand.
No, definitely. And you're spot on about keeping records up to date. That's always key in these areas. Now, you mentioned about the venture capitalism side, and obviously, we all hear the wonder stories of your large corporates blowing up and becoming $1 trillion companies and things like that from startup space, which obviously, being within the industry, I know that's not as common as people might think on the outside. So, there's numbers thrown around with how many of these companies are successful versus how many have a very short shelf life. And I'm putting you a bit on the spot here. So, like, obviously, when people are investing in these companies, venture capitalism, I try to highlight that it's still important to apply the rules of diversification, because it's unlikely that you're going to pick the one company that turns into $1 million company. There's liquidity impacts that you've got to focus on. That obviously within Australia, this market is quite small from a secondary sale of shares. Can you elaborate on any of that areas? Obviously, you're quite heavy in this space.
Yes, right. And I guess for context as well, it's sort of most of my career was spent in as CFR for technology companies. And raising capital as a CFO in tech is something that you end up doing quite a bit. And so for investors, you're spot on, right? They need to understand that it's unreasonable to expect a win on one investment, right? And I guess perhaps a better approach is to build a portfolio of investments. So you need to make sure that you have the ability to build a portfolio. You're not just writing one check, you're actually writing a number of checks to build a solid portfolio of companies. And then you're also spot on that many of these companies will not succeed, right? So what you probably see on the landscape of startups, there's a cohort of companies that are founded and just don't even make it to capital stage, right? They kind of end up being lifestyle businesses, or just kind of die. Then there's companies that do make it to funding stages, various funding stages, and again, not all of them succeed. Some of them completely fail. Some of them achieve reasonable returns, and some of them achieve outsized returns. But the proportion of companies that achieve outsized returns is really quite small, I guess, really quite small. So you need to make sure that it's sort of in the way you're building your portfolio, you're allowing for the fact that some of the portfolio will completely disappear, some of it will return, and some of it will provide hopefully outsized returns. But what's important is sort of in approaching that journey of looking for startups and investing in startups is that it really is a journey. It's not just a one decision to become an angel investor or to become an investor and to write a check. A lot of the time, it's a bit more involved, right? So you need to be in the sort of in the deal flow or near to the deal flow, right? So you need to be networking and continuously looking for good opportunities. Good opportunities tend to go to really well-known, really well-respected investors first. So you don't want to be, an investor that just kind of gets deals that nobody else wants. You want to be in the deals that are actually well structured, well vetted. Presents a really good lead investor who will do really thorough due diligence, and sort of that will hopefully increase your chances of building a strong portfolio that will provide returns. But it kind of to sum it up is you're right. There's a lot of risk, and in order to try and manage that risk, it really is a journey. For lack of a better word, you need to be identifying as an early stage investor, and you need to be building both a portfolio, but also a bit of a profile, right? A bit of a personal brand in order for good deals to be, in order to be included in good deals.
Yeah, definitely. So you need to be kind of within that ecosystem to be involved, and that's where people like yourself can really help out there. If you're looking through the books, obviously you've got a wealth of experience being CFOs for a lot of these tech companies and things like that. You've got that experience to be able to identify which of these companies are in a bit of risk and which one of these companies are a bit more of those sound investors. Now, in terms of time frame until these successful companies, what sort of time frame would you expect like a sophisticated investor to get that return on their money if the company is successful? Is it 1 year, is 7 years, 10 years? What's the average before they can get funding?
I think it's across the board, but it's the time frame is it is not, there's limited influence on the time frame. A lot of the time, investors who write a check to an early stage company effectively have limited liquidity for quite a long period, right? So it's they may have some investor protections that will let them exit if the company has sufficient capital to let them exit early. There may be opportunities for some secondary sell down along the way, but again, those opportunities are often limited. So I think investors that are writing these checks need to be prepared to be on the bus for full journey until the company is either listed or acquired, until there's a significant liquidity event, which can take a long time, right? I think there's sort of a 10-year expectation is probably a fair one, and that's what we experienced with our previous company ourselves.
Yeah, perfect. No, that's great. That's great to know. So if you're kind of reaching out to people that might be wondering, are they a sophisticated investor or not? Where's the first place that they should be looking to go? Yes, I think I meet those requirements. Let me talk to an account.
Look, the Australian Tax Office has a fair bit of reference material on their website. I think that's a good start, and so does ASIC. And you'll see that sort of fund managers and venture capital funds that want to build, their funds from sophisticated investors will have information as well. But a good idea is to talk to a trusted advisor. And I think if you are really considering sort of going on that journey, ask your accountant whether they can help you develop the network and be in the deal flow, right? And sort of the certification is a formality that just comes that's required. But to be successful, sort of just having a certificate is really not gonna help you. You really need to be sort of gaining an understanding of the full, landscape. And when we're approaching this, our focus on wealth creators, being both founders and investors, it's all, I guess, with context that in order for Australian startup ecosystem to flourish and keep growing, you really need both sides of the equation. You need to have brave, ambitious founders who are, who are taking the leap and taking the risk. And at the same time, you do need to have a really good size cohort of investors that are participating at all stages, from idea and pre-seed to seed, Series A, Series B, Series C. So in a way, the fact that Australian sophisticated investor rules haven't changed in so long, and the cohort of people that are participating is growing, is really great for the ecosystem. I think Australian startups are benefiting from it. What we want to do is make sure that people that are now qualifying as sophisticated investors are also getting sufficient level of knowledge and introductions and feedback and advice to make sure that they're actually making the most of the opportunities that do exist in Australia.
Yeah, no, perfect. And you can see the environment growing more and more. Obviously, we met at one of these events where there was a lot of founders there, and been going to them for a little while now, and you can see the crowds getting bigger each time. The level of experience in the room is getting bigger each time, and starting to see that roll-on effect, which is great. And it's good for the Australian environment there as well, which is great. So
And I think we're actually, I think, going through another really exciting wave of new style of founders coming through that are deploying and using AI in their businesses. Sort of when I was first getting into the technology space, cloud computing was I guess, that wave of change where enterprise clients were adopting cloud tools for the first time, right? So everything cloud was new, and you really had to defend the fact that cloud was a good idea. And the last couple of years, this wave of AI is doing the same. So which creates both an opportunity, but also a lot of change that needs to be understood and managed by both investors as well as founders as well as advisors.
yeah, no, couldn't agree more. AI is definitely making a huge wavelengths and reducing a lot of costs to get into the industry as well. Now, what we always offer at the end of this podcast is an opportunity for you to plug away whatever you've got going on in your life. It can be business related, it can be personal related, or the stage is yours.
Nice, thanks, Ross. Really appreciate it. We're excited to start this firm this year, and take all the lessons learned from our previous companies, and share them with the ecosystem, right? With the wealth creators, so not just founders but also investors. What we're trying to do differently is actually put our money where our mouths are, and support founders with a little bit of capital when they're putting together a raise as well. So if we work with the founder, I think what we want to signal to the rest of our network is that we believe in the founder and we believe in the opportunity and the quality of the materials that we're helping put together as part of this raise is, we're prepared to fund it ourselves. So at times we'll be foregoing our professional fees to wrap it into the round, and hopefully that will signal some confidence to other investors, but also help founders shape good, strong rounds and hopefully close them faster. Right? Capital raising can be very, very time consuming. This firm, is being co-founded by myself and a co-founder from our previous company, Wayne Gerard. Wayne's founded several businesses and taken them all the way from idea to exit to Fortune 500's strategic acquirers. So has a wealth of knowledge and experience. Again, trying to do differently is focus on advice and offer accounting, compliance, and tax as things that are necessary, but they're not necessarily the things that will help you achieve success. similar with the sophisticated investor certification. It's necessary, but it's not really going to make you sophisticated, right? There's a broader, I guess, advice that you will need along the way in order to achieve success. So that's what we're, I guess, looking out to do this year. And if anyone wants to reach out and ask questions, we're more than happy to support people.
Yeah, perfect. And obviously, all your details will be in the links to these videos. But if they can't get a hold of yourself, they can reach out to me and I'll pass those details on. And yeah, I can't think of a better plug than that for yourself, given that you are willing to, if these companies are growing and you are willing to put your own money into these companies to help them elevate themselves even further. So yeah, it's amazing. I appreciate your time today, Roman. Obviously, coming on. It's been great to have you on. Yeah, look forward to seeing you guys grow. Thank you guys for listening. I'm your host, Ross Pocock, co-founder of Sternlight Financial. As always, new financial year this year. So if you're looking at setting up your goals or anything like that, feel free to reach out. Yeah, we look forward to working with you. But thank you for listening, like and subscribe.